Welcome. I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Vince Stefano, where we're here to provide you insights about the markets, taxes, and much more. And here we are. Today is November 13th, and top of the news is we finally have the end of the government shutdown.
Hooray!
43
7?
Five.
I just know I can call the
lost
IRS
count.
finally for
I
clients.
It was a long time, so just really happy that that's done with.
Is that why you got some guidance from the IRS today?
Well, I haven't gotten through yet on the bat line,
Oh,
but
gotcha.
that'll be later.
Well, and the IRS came out, just set the 2026 limits, which we'll touch on a little bit later.
Yeah.
Also, there's still earnings coming in, so we'll talk about that. And just, where we're at with the markets right now. So here we are as of yesterday's close, which was November 12th. The Dow Jones, which we saw shift into some value stocks. So the Dow Jones was actually up as of yesterday. Year to date, we're up 13.42, which was over 2% from last week. The Nasdaq was actually down from last week to this week. It's still up for the year. It was up as of yesterday, 21.21, down about 0.5% from last week, but there's more. Today we're actually seeing a pretty big drop in the Nasdaq and the Russell 2000. So we're seeing about a 2% move, which we'll see what happens by the end of the day. But just, I know I'm giving you some good news, but the reality is every day is a new day. And then the S&P 500 as of yesterday's close was up from last week at 16.48, and the Russell 2000 was actually down from last week. Was at 9.89, and obviously, like I mentioned today, the Russell 2000 is down today at about 2% so far. But one of the things that we do talk about, and probably one of the reasons we're seeing a change in the markets a little bit, is the Fed Watch tool came out, and basically, I know last week we said it was about a 65% probability of a rate cut, and now that's gone down to 55% chance of a rate cut
In December.
In December, correct. So we still have a couple more weeks to go, so a lot can change between now and then. But I think the markets kind of already had priced in there was a rate cut, and I think there's some questions now if that's going to happen or not at the end of the year. So there's that. And then mortgage rates, actually right now, the 30-year is about 6.24, so we've seen a slight uptick there over the last week. And then I do look at the short term, kind of see where we're at with some of the yields for short term fixed income. CDs from last week to this week, we're actually seeing a slight increase in the CD rates. So 1-year CD is at 3.7, and the U.S. Treasuries from last week to this week is pretty similar to about 3.72% in the 1-year Treasuries right now. So not too much movement, but a slight movement. Once again, year to date, I still think we have some positive numbers in the markets. It's just along the way, there's a little bit of volatility and market movement. And so I know we have, next week we have some of the consumer, some of the consumer stocks are going to report. And I know there's some question on the holiday spending and what's to come. So I'll probably let Vince share about that.
Well, I'm going to just say that I've been really surprised. Up until today, I've been very surprised at how the market has continually shrugged off bad news. I mean, government shutdown, I don't know, 45 days, 43 days, whatever it was, other types of economic concerns, and yet, the market pushed higher. And, since the tariff announcement, the, S&P is up 16%, and that has created $5 trillion worth of wealth for the United States. Yeah. And it's kind of interesting. It was a Wall Street Journal article, and a lot of the commentators have been talking about this. Americans that have a big portion of their investment portfolio in stocks feel so much better about the overall economy and their finances than those people that have a much lower equity allocation. And what's interesting is that wealth effect is causing an increase in spending, especially in big ticket items. Economists are saying for every $1,000 that your portfolio increases, you spend an additional $35 to $50. So that's, more trips to Starbucks for your latte and, get your nails done and all that kind of stuff. That's for you, Greg. I know you went to the.
petty?
I know you had the petty the other day.
Don't mess with my petty.
But, even more interesting, from the first quarter of 2020 to the end of the second quarter of 2025, Americans gained over $65 trillion in household wealth.
Wow.
$65 trillion. Real estate contributed 61%. Anybody want to guess what stock market contributed? Come on, no takers. 122%.
120.
Okay.
So think about that.
Yeah.
Doubled real. Everybody thinks that, real estate. But when you think about it, over a 25-year period, stocks more than doubled what real estate did. Now,
25 years or 5 years?
25 years. From 2020, I'm sorry, from
25.
2010,
To year 2000.
20 from the year 2000
Okay.
to 2025, Americans gained 63 trillion. So that's a
Okay.
25-year period.
Got it.
So in that 25-year period, real estate went up 61%, stocks went up over 122%.
It's impressive.
But also pretty interesting was that in the last, 5 to 10 years, the S&P is up 498% and the Nasdaq's up 1,000%. Now, that you got to think about what's caused that, and that's the big mega cap tech stocks. And what I've been saying all along is, the market is a huge creator of wealth. And you've got to be in the market if you want to create the kind of wealth that we're talking about. And up until recently, as Catherine was mentioning about earnings, the market had a good upside because of the earnings reports and the guidance. And what happens is investor risk appetites begin to increase because of that. And I think you're going to see, the next 30 to 45 days, I think it's going to be relatively positive for the market. And we're also going into a seasonally strong period. And I think from Thanksgiving to the first week of January, it's fairly seasonally strong period. We get into that Santa Claus rally and all that. But I think what else is happening this year, there's a lot of money managers underperforming their benchmark, whether it's the S&P or whatever, and whether it's on the institutional side, retail side, mutual fund side. And I think you're going to see a lot of these guys trying to juice their performance a little bit between now and the end of the year. Otherwise, Lucy's going to have a lot of splaining to do in that year-end meeting when they go visit their clients. So I think
it's Desi, isn't it? It has to do this planning.
So I think you're going to see, a lot of, stocks begin to, move off this quote negative sentiment that's kind of circulating around right now. And I think that's going to be a real bullish setup between now and the end of the year.
That's interesting outlook. The other side of that coin, just to balance this out a little bit, is, if you look underneath those big cap tech stocks, there is a lot of weakness out there, and everyone's been talking at various periods during this year about the broadening of the equity market. There's some statistics out there about that underlying weakness that we've seen recently that has only happened a couple of times in history, and they've preceded some pretty ugly markets. So I'm just saying, I wouldn't just go all in. I know you love the equity markets, and we all do. It's it does create a lot of wealth, but if you're not all in now, I wouldn't necessarily just go all in to these big cap stocks at this point.
Well, we're also, over the last few days, have seen a rotation shift out of some tech stocks into more value. But once again, then that ties into what Rachel and I were talking about earlier today, was we're at the end of the year. There's a lot of clients looking at some gains or what's their allocation, and maybe there might be some tax, some tax loss harvesting. Is kind of some things that we've been talking about recently. And so, not that you'd get out of everything, but this is a chance where you can look at your positions, and if you want to, if you're overweighted because it's gone up so much, maybe you reduce it a little bit, and then is there any other positions that you can sell? And do you want to share some other things you found regarding that?
So basically what we were talking about is if you do have the gains, is to take a look at your portfolio and are there any losers there? And I mean, it was amazing remarking that there were a lot of people that were looking at that don't have any losers.
Yeah, it's been
So,
the market's been so good.
Market's been good, but one of the other things that I mentioned in the other podcast that Catherine and I recorded today is it's not just stocks; it's also other capital assets. So, for instance, one of the things I've been seeing a lot this year is a lot of people's elderly parents are passing away, and there's that wealth transfer that's happening, and often the family home gets that stepped up basis when the parent passes away. And then with real estate fees, there are losses. There's a loss situation, and so you can actually use that in the final year when you close out the estate or you close out the parents the final return. Those losses do pass out to the beneficiaries, and you can use those to offset. But one of the things so going back to tax loss harvesting is that's looking at the gains and the losses in your portfolio and selling things off, and so that you can net your gains and losses. But you do need to be careful about wash sale rules, meaning losses don't count if you buy back similar securities within 31 days, let's just call it.
And then the other thing that I know you've mentioned over time, Rachel, is maybe there's some tax loss carry forwards.
Correct.
Yeah.
So one of the things that people often overlook, and if just say you switch tax advisors, is make sure you're looking at your tax return or make sure that your tax advisor has that, because there are oftentimes losses in excess of the gains, and you only can take. So the gains and losses are netted, and then the addition, you could take $3,000 against ordinary income being wages or interest, et cetera. But any losses in excess of that carries over. And so you want to make sure you're planning for using those up as well and not losing them.
But you can carry those over as long as you want, right?
I think it's 20 years.
Oh, 20 years.
Yeah,
Okay.
I think there's they changed
If you
that
haven't
rule.
used it in 20 years, yeah,
exactly.
something's wrong.
Yeah. I may be wrong, but because they have changed that rule.
You just
But
don't have a lot.
There's always a
in
rule
your
for
There's always a
portfolio
rule for
to offset the
rule,
losses,
yes.
You're in the wrong stocks, obviously.
Exactly. Yeah.
The answer when it comes to IRS is it depends.
There you go.
Yes.
So maybe why don't you talk a little
I'll
bit
jump
about some
in.
of
Yeah,
the
so one of the
changes?
exciting things is the IRS yesterday announced, actually they announced
I
it
said
on the
today, or just
13th.
today?
Wait,
Okay.
what day is today? Today's the 13th.
13th,
Yes.
yes.
So the announcement was today.
Yes.
What year am I in?
Right. We're in 2025. I'm in 2026 already. I don't know.
So the 401k limit has been increased for 2026 to $24,500, and there is a catch-up contribution if you are over age 50, and that has been increased to $8,000 plus the $24,500. And then if you are contributing to a traditional or a Roth IRA, the limit did increase to $7,500. For simple IRAs, the rules are not simple, so call us.
Yes. Sure.
There's
What's the catch up on those IRAs?
on the IRAs, it's 1,100, up from 1,000.
1,100.
1,100, yes.
They've always bumped that like $500.
know.
What's
Yeah.
I'm
$100?
surprised.
Well, their Social Security may not be as solvent
Yeah,
as
but-
you
but
think,
they
so
would-
you
they
better
would-
save
500.
like crazy.
Yeah.
But we're saying maybe they usually do like 500 so
Yeah.
it should have been 1,500 or 2,000.
Yeah.
But a lot of people do have simple plans, like you were saying. So just generally on simple plans, the limit for 2026 has increased to $17,000, up from $16,500 for 2025. And then if you're over 50, it depends on the kind of plan that you have, but there is a catch-up contribution of $4,000. If you have what they call an applicable simple retirement account, then for your contribution, it's $18,100. So again, not simple.
Yes, and
If
that's
you-
for only certain plans.
certain
and you have to
plans.
mark it.
And then if you're 60, 61, 62, or 63, then there's an additional catch-up. So again,
call us. Yeah,
please,
we'll help you.
because
It's kind of funny that they came out with these simple plans
That are
to
not
simplify
simple.
the 401k, yet it is way more
It
complicated.
is.
seems
We were
like.
just saying that. Like, there's so many
Different
so many
rules.
rules.
So speaking of rules, let's jump in. Let's talk about charitable giving, because those rules have changed significantly for 2025. So there are some planning opportunities for the remainder of 2025. Did I say the charitable giving has significantly changed for 26?
Yes, that's correct.
Not for 25. For 25, so what you need to keep in mind, for 26, there will be a new universal deduction for non-itemizers. So basically, if you're taking the standard deduction, you can claim an additional, what they call above-the-line deduction, so you don't have to itemize. And this is for cash contributions of up to $1,000 for single filers, and if you're married, $2,000. So that's basically a reduction of your taxable income by $2,000 if you're married, $1,000 if you're single. There is a new adjusted gross income floor for itemized deductions for charitable contributions starting in 2026. So basically, kind of like the medical deduction gets a haircut, they've put something in law that also charitable contributions will get a 0.5% haircut. It starts next year, so just keep in mind, and there is a cap on the deduction value for top earners. So if you're in the 37% bracket, the benefit of your charitable gifts there's going to be a cap. So for 2025, these rules don't start until next year. So you may want to consider accelerating gifts into the last few weeks of this year to take advantage of that current more favorable rules before that new AGI floor, adjusted gross income floor, goes into effect and the 35% cap. So some of the strategies we look at is bunching, donate your deductions into a single year. So maybe 1 year you're itemizing and the next year you're not itemizing. So work with your tax advisor on that or call. I'm happy to give you a consult. And then for non-itemizers, it might be beneficial for you to wait into 2026 to do the cash donations because they have the above-the-line deduction for non-itemizers. So there's some considerations there to keep in mind. And the standard deduction is so much higher than it used to be that a lot more people are taking the standard deduction and not itemizing anymore. So check last year's tax return to see kind of where you fall, to see what makes sense for you. And then finally, final planning tip on charitable donations is for retirees, 70 and a half and above. Qualified charitable distributions from an IRA, they do remain a really powerful tax-efficient tool, and they're not subject to that new AGI floor or the deduction cap. So just
That's a workaround.
That's a workaround. So call us for more information.
That sounds like a lot of blah, blah, blah.
Wow.
Call your tax
And,
advisor.
and basically, they did all that during the government shutdown.
There you go.
Yeah. Like, yeah,
Somebody was busy.
Somebody was busy at the IRS.
It's the Accountants Full Employment Act.
No kidding.
And then as you're going through these items, as we're now approaching the end of the year, this is also a good time. Once again, did you max out your 401k
Yes.
or your catch-ups for 2025? And if you didn't, get those in if you can between now and the end of the year. And then for next year, you want to make sure it's in place with the new amounts that you're deferring that out in your salary deductions. So just make,
And the RMDs coming out this year. by the end
And
of the
then,
year.
yes, so those are, if you're clients of ours, we've notified you, we've sent letters, we've called. So
And
if you haven't done
RMDs
it,
are required minimum
Minimum
distributions.
so if you have not done that, we will be in touch with you, or please give us a call, because I know we make sure
getting
that
close.
I
gets
sat
done.
with a client yesterday, and I was like, here's the letter you got back in September for this RMD. And
We need to do this
They were
still.
like,
Oh,
wonder where. When did you send that?
And keep in mind that make sure that you are either A, withholding enough tax or making your estimated payments to cover not just your required minimum distribution, but also your investment income. Because I've had a couple of clients this last year say to me, I didn't realize I pay tax on my investment income if it gets reinvested.
Oh, interesting.
And that was just a light bulb moment for me, because they were like, I didn't understand why I was paying so much in tax every year until you're
You're talking about dividend reinvestment.
dividends, or interest, capital gains.
Gotcha.
They didn't realize that they actually had to pay tax on that. Or, for instance, they are invested in a partnership, and there's income, but it's being reinvested in the partnership. You have to make sure that you're covering your tax liability.
So I have a fun fact. It looks like the U.S. Treasurer is going to end producing pennies.
Saw that this morning.
Yes,
Yeah,
and
so I did see
so
that.
it's after 232-year run, and so I wanted to share. Find a penny, pick it up, and all day you'll have good luck.
There you go.
But I was looking at it, I was like, oh, so Abraham Lincoln's on the penny, but he's also on the $5 bill. Because I was thinking if you ended up, removing the pennies at some point. But what I didn't realize was each penny costs $3.69 to make.
Oh, wow.
Whoa,
Isn't that
that's
crazy?
No wonder,
Yes.
no wonder we got
I thought it was like 3 or 4 times the cost of a penny, but it's $3.
That's how we have a $34 trillion budget deficit. There you go, making too many pennies.
What does it cost to produce a nickel?
I don't know. So, and it's just one of those things that was just kind of interesting to see, obviously, that things have changed over the years. And the circulation, it peaked $17 billion in 2015. And then
17 billion coins.
pennies,
Wow.
and then circulation, and then it's fallen every year. And it says it was 11.4 billion in 2023, and it's tumbled to 5.6 billion in 2024.
Think about that, 17 billion pennies, and it costs $3 to make a penny. Think
Or
about
3
what
cents,
that,
yeah.
that's a
Yeah.
lot of money.
Yeah.
It's a lot of money. Another little factoid. What was the last coin that we discontinued?
I don't know.
$half?
It's a half of something, but it's not the dollar.
I don't know.
It's a half penny.
The half penny.
Half
I
penny.
know.
Yeah.
What?
Yeah.
Wow.
And I forget the date, but I think it was about in the 1700s.
Oh, okay. Yeah.
Fun
all right.
fact,
Yeah, when
right?
we-
Fun
when
fact.
we- yeah, when we-
Every couple hundred years, we got to
when we-
get rid
when
of
we-
that,
yeah, when we
that
kicked
little
it-
one.
Right. When we got our independence from
But what do
Britain.
all
we-
the retailers do? They round up if it's like
Everybody
$1.01,
pay-
they go $1.05.
Everybody pays by card, so it doesn't
Yeah.
matter. Nobody has a penny on them anymore.
Well, retailers have been having a problem. They're running out of pennies because they have been. People just don't use them. They put them in a bank. They throw them on the ground. Nobody picks them up.
I pick them up.
I pick them up.
I'm going to start picking them up
start
because they're a
picking 'em
collector's
up.
item now.
Yes.
Right? All right. So I thought I'd share the Fear and Greed Index and share a little bit about what that is. I know we've talked about it a few times. So extreme fear is from 0 to 25. Fear is from 25 to 50. Neutral is from, about, it looks like it's a little about 45 is for fears. Then 45, I can't really tell. There's neutral about in between 50. Greed, it looks like it's about 55 to 75, and extreme greed is between 75 and 100, and those are estimates. But what I wanted to share is how it's calculated. So the Fear and Greed Index, it has 7 different measures, and it looks at momentum, stock price strength, stock price breadth, put and call options, junk bond demand, market volatility, and safe haven demand. So basically, there's a lot of different indicators and indexes that are tracked to get this. And once again, today, as of this morning, November 13th, we were at 27. So
And
once
that
again,
is neutral?
we're in fear. So
Fear.
fear
Bottom
is
of fear.
We're
yeah.
like,
Yeah, so we're just crawled out of like extreme
Extreme fear, yeah. Extreme fear is 0 to 25. But I'll get the more accurate allocations between the different ones. But right now we are in fear. So it's interesting. I mean, the markets are still up, but obviously we're seeing some market volatility or movement. And what we find is a lot of investors like the upside and no downside. But along the way, there's definitely some
yeah.
market
Well,
movement.
it's funny that we're deep into fear, and we're a couple percent off all-time highs.
yeah.
well, I think the real volatility recently has been, with the fact that the Fed may not cut in December.
Right.
Yeah,
And Catherine said it's priced in.
Yeah, that's the big thing this
And
week.
I think that's why you're starting to see, you've seen the Dow rally a little bit recently is because, somebody had mentioned value stocks.
Mm-hmm.
Well, value stocks have underperformed for the last, 2.5, 3 years to growth stocks.
Yeah, probably.
So
Yeah.
those of you who are in growth stocks, don't give up. I would use any type of pullback to be a buyer. And because that's where the innovation is, I think over the next 2 years, you will continue to see massive amounts of innovation from these tech companies. I think you'll see, and you're seeing a lot of increasing CapEx, and that's important because capital expenditures from these companies are going out and they're increasing their footprint in the overall marketplace. And whether they're doing it in, building data centers, increasing, or developing new software or something. There's just so much innovation happening. That's where I think the excitement will be for the next 2 years. But, now we're having this little bit of a pullback. Don't get nervous. Stocks fluctuate, happens all the time. Stay with really good, high-quality growth stock names, and I think over the next 2 years, you will be one of those people who is, able to spend a whole lot more money. Buy your big
On
ticket
mani-pedis.
Right?
On mani-pedis.
So we do have clients, and the reason why they have the value stocks or some dividend stocks is they're looking for income and appreciation of stocks. So yes, we do like the growth stocks and the tech stocks and for growth, but a lot of our clients do have a combination of both. And once again, it's designed per client and
We
kind
have
of
a
what we're
plan.
working- and what
Yeah.
we're working the plan.
Well, I'm not saying not to buy them. I'm
Yes.
just saying where the excitement in
Yes,
the
absolutely.
and the
Yeah.
big innovation is going to
Yes.
be, and I think where the biggest gains will be over the next couple
But
of years.
a lot of our clients are getting older, and they're they get real nervous with the volatility. And there's a lot of ways to mitigate the volatility. It's buying value stuff, it's hedged portfolios, it's structured notes. But yeah, I agree. I mean, all you see out there, and especially with the younger generation, the e-traders and all that, is these high-tech stocks, which is where all the money is right now.
That's where the momentum is.
Yeah.
You know. Anyway.
All right. Well, I think that concludes this week's podcast. And thank you for joining us. And until next time, thank you.
Thank you.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.